Hi, and welcome to another episode of Talking Legal with Templars. My name is Chibuike Ikefuna. I'm an associate in the tax practice group of Templars. With me here today is Dr. Jude Odinkongibo. Dr. Jude, welcome.
Thank you
to another episode of Talking Legal with Templars. Recently, during the budget speech, 2022 budget speech, the Minister of Finance indicated that the Federal Inland Revenue Service will begin to appoint non-resident digital companies as tax agents of the FIRS. The minister also indicated that turnover tax will be extended to non-resident digital companies that earn income or profits from Nigeria. What do you make of these amendments?
Oh, Chibuike, thank you. That's correct. The minister made those statements. To be frank with you, prior to the Finance Act 2021, actually 2020 Finance Act actually made provision for appointment of non-resident persons or taxable persons in Nigeria as tax agent for the FIRS. So this was repeated in the Finance Act 2021. So what it means is that the Federal Inland Revenue Service, by these amendments, which amended Section 10 of the Value Added Tax, can appoint any non-resident person or non-resident digital company in this case as tax agent for the FIRS. That is for the purpose of collecting and remitting value-added tax from goods and services supplied to Nigerians, the money made from goods and services supplied in Nigeria to the FIRS as VAT. Wow. That's correct. Wow. Now, coming to the turnover tax, traditionally, Section 30 of the Company Income Tax Act provides for the imposition of turnover tax. Okay. And the question is, what is turnover tax? Turnover tax mainly are taxes that are imposed on companies when FIRS cannot determine the assessable profit or when the assessable profit is less than expected. The FIRS can rely on best of judgment rule or best of judgment assessment.
Okay, so it's at the discretion of
the
FIRS.
which is subjective to impose what you call the turnover tax. Normally, in practice, FIRS will look at, if it determines the turnover of a company, it will pick out 20% of that turnover, impose 30% rate, 30% on that turnover. And some have argued that this relates or comes out to an effective 6% of tax rate. So now, in this case, with the Finance Act 2001, the federal government now extended turnover tax to non-digital companies, non-resident digital companies. And what are the non-resident digital companies? Non-resident digital companies are companies that do not have physical presence in Nigeria. They don't have what you call permanent establishment, they don't have a fixed base, or perhaps may not even have agents in Nigeria.
No trace of them.
Yes, these companies don't have physical presence, but they make money from Nigeria, digitally or virtually. For instance, Facebook, Netflix, LinkedIn, Amazon, and yes, and the rest of them. And remember that in 2019, Nigeria introduced digital taxation, which amended the Company Income Tax Act by providing a company that transmits or emits or transacts makes money from Nigerians, and to the extent of meeting the significant economic presence threshold, that company should be able to pay income tax in Nigeria. Okay. So in that case, such companies are required under this if the FIRS determines that the company, maybe you've not filed your income tax returns, or you did file, they filed it, or the company files that, but the assessable profit is not determinable in case if you have not filed, or you filed it and they feel that what you filed is less than expected. FIRS can impose turnover tax. Then in this case, I would want to ask you, because knowing full, I don't think FIRS, it appears, I don't know how many companies that non-resident companies or digital companies that have actually complied since 2019. Maybe that was what led the federal government now to come up with this turnover tax. So we foresee enforcement problems. So what do you have to say about how the FIRS could go about enforcing this, especially when these companies don't have a physical presence in Nigeria?
Thank you very much, Dr. Jude, for that question. We foresee a lot of enforcement challenges Even though the amendments introduced by the Finance Act may appear sound and laudable, there are enforcement challenges with the law, particularly with respect to the turnover tax. Now, imagine a non-resident digital company that have customers who use debit cards or credit cards that are not issued by Nigerian financial institutions.
Exactly.
It will be particularly difficult to trace the transactions consummated with those credit or debit cards.
Exactly.
So if, for example, I'm in Nigeria and I have a Bank of America card,
exactly,
and I subscribe to a platform, a non-resident digital platform with my Bank of America card, the FIRS would find it particularly difficult to trace my transaction. And in turn, that will lead to a difficulty in determining the turnover of that non-resident digital company.
Exactly.
And in turn would also lead to the FIRS not getting the full or the maximum effect of that turnover tax provision. So I think this is one of the enforcement challenges with the turnover tax. Then coming over to the appointment of non-resident digital companies as VAT collection agents. The most prominent challenge there would be the refusal of the company to act as an agent of the FIRS, because you can't. I don't think the FIRS can.
What happens? How will FIRS compel them?
Exactly, because
yes,
they are not within the territorial reach of the FIRS.
Especially when they're dealing with business to customer, especially those who are not registered with FIRS.
Exactly, you can't really cage those companies.
Yes.
So if the company refuses to act as an agent of the FIRS, I think that that provision there's going to be a lot of setbacks with the whole appointment agenda.
But again, don't you think that a company that really wants to do business in Nigeria wants to comply with Nigerian laws?
On the flip side, yes, but
that it will be better for the company to comply.
Yes, it should be better for the company to comply with Nigerian laws, with Nigerian tax laws, but then imposing another obligation on the company to collect and remit tax would, in my opinion, would lead to the company spending more on compliance. Yes.
Yeah, but even if it spends more on compliance, can it claim it as a deductible expenses? If the company proves that anyway, this money we're spending in compliance could form part of deductible expenses, we can claim perhaps in the next financial year.
Well,
can they make such a case?
They should be able to make such a case. Yes, I believe so.
Okay. Yeah.
Finally, despite the public criticisms against the amendments, we think what is important is for taxpayers, including non-resident digital companies, to comply with the law because the law remains the law.